All right, chapter 4, merchandise operations. Um, yeah, I'm trying to lecture without moving my hands so much, and it's almost impossible. Anyway, um, I just want to see if I can do it for a little while. Chapter 4 is the beginning of accounting for a merchandising company. So the two overriding assumptions throughout this course for the rest of the semester is one, we're dealing with merchandising companies. A merchandising company is a company that buys inventory from a manufacturer and then it puts it on its shelves and then sells it to consumers like you and I. A perfect example would be Walmart, Amazon, companies that don't make products themselves. That is what financial accounting, this class, is dealing with. The second underlying assumption is that we're also dealing with a corporation, and we'll get into that and what that looks like way later in the course. But those are really the two fundamental assumptions about this class and the type of companies that we're now accounting for moving forward. And so this chapter is really the beginning of how do we account for the purchase of inventory and then the sale of inventory. And we call that, or we refer to it as, the operating cycle. And this whole week or this whole chapter really is all about the operating cycle. The goal, what we're going to try to take away from this chapter is this video, I'm going to go through and talk about just merchandising activities and the operating cycle itself. We're going to ignore this. We're not going to really talk about the acid test and gross margin ratios. Stuff is interesting, but for the most part, we have our hands full with everything else. So we might as well stick to the important stuff. In the subsequent videos, I'm going to talk about this learning objective 1, which is purchasing inventory. Then learning objective 2, it's like P2, we're going to sell the inventory. Learning objective 3 is we're going to make some adjusting entries and some closing entries specific to a merchandising company. And then finally, the last thing we're going to talk about is what the multi-step and single-step income statements look like for a merchandising company. All right, so the takeaways really of this lecture, in this particular video, I should say, are a couple things. The first thing is we're now wanting to be familiar with some of the main components of the income statement for a merchandising company. And there's some new terms. Okay, so if I'm talking about the income statement, we now know we have revenue. And I'll just make some numbers up. But I have revenue. It could be $100,000 in revenue. Now, a new line item, it's an expense, and we call it cost of goods sold. And I'll just make a number up. We can call this $30,000. Cost of goods sold, that's like if I'm Walmart and I have a row of Barbie dolls that I'm selling to consumers, the cost of the Barbie dolls, right? So if I'm paying $10 a Barbie doll to Mattel and then I'm selling those to customers, the cost associated with those Barbie dolls is what I refer to now as cost of goods sold. The difference between revenue and cost of goods sold is gross profit. And in our example, it's just 70,000. And then after gross profit, so look, if you think about Walmart, we're not just selling Barbie dolls. Okay, maybe we're selling all sorts of other things, but beyond the products that we're selling at Walmart, there's all sorts of additional costs that we incur. For example, salaries of the individuals who are working at cash registers and stocking the shelves. the rent on the store itself, the electricity that we're using. We call all of those costs beyond, the physical products that we're selling. We call those operating expenses. And so we will subtract operating expenses from gross profit, and I can make up some number again. The difference between gross profit and operating expenses is net income, to be overly simplistic. And in our example, we have net income of $50,000. Okay? So, cost of goods sold and revenue, right? These two line items right here is really what we're going to spend most of our time talking about this week and learning about this week, right? So if you think about Walmart, Walmart is going to have, we can call Walmart a merchandiser, and Walmart is going to have to go and acquire goods and services, goods mostly from the manufacturers, right? And the manufacturer in our example could be Mattel. It could be Sony. It could be any company that's making the products that Walmart is going out and purchasing. Once Walmart buys the Barbie dolls and buys the TVs, puts those on the shelves, then we were going to sell those goods and services to customers or consumers. And that's us, right? So the sale of merchandise is obviously going to generate revenue. And then the purchase of merchandise is going to lead to cost of goods sold. All right. That is the operating cycle. What we're basically saying is, if you think about it, I have a bunch of cash, okay, and I'm going to convert that cash to inventory, right? I'm going to go buy Barbie dolls and TVs. I'm going to mark up the inventory and I'm going to sell that inventory to consumers, and hopefully, right, that generates more cash. And then with the more cash, I'm going to go out and I'm going to purchase more Barbie dolls, more TVs, and it's just going to be this continuous cycle that we refer to as the operating cycle. In a lot of the discussion this week, we are going to keep track of an inventory account, okay? And to just be completely simplistic, we can think of just a single product company. I don't even know a company that only sells one product. In fact, it could be me. I could just be selling hoodies, right? Perfect example. I am going to have a beginning balance in my inventory. And again, I could just make this up. I could say I have $10,000. And then during the period, I'll purchase more hoodies, right? And so I could add inventory to my account. And therefore, I would have available to sell $30,000. I will also have cost of goods sold, right? I will lower my inventory account by the cost of goods sold. And so let's just say that I sell $25,000 worth of Barbie dolls. If I have available inventory of 30,000 and cost of goods sold of 25,000, then my ending inventory is going to be 5,000. A different way that we can refer to that, we can do that with respect to a formula, but we could say the beginning balance plus purchases, that is going to equal, either I'm going to still have that inventory or it will be cost of goods sold, right? So my beginning balance, 10,000 plus the purchases of 20,000, that's a total of 30,000. That will equal my ending balance of 5,000 plus my cost of goods of $25,000, right? This really is, big overarching, the income statement. The second overarching issue is the operating cycle, right? And then the third is the inventory account. Okay. The remainder of the discussions, right? We're going to have one lecture that just deals with the relationship between the manufacturer and the merchandiser, like purchasing inventory. Then we're going to have another discussion about the relationship between a merchandiser and a consumer. That will be a second lecture. Then we're going to have a lecture just related to the income statement, and then one lecture to close out stuff like revenue and cost of goods sold and all the other different types of revenue accounts that we're going to talk about tonight, or this week, I should say. But anyway, this is chapter 4, the operating cycle.